Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I'm co-host of this podcast, CEO and founder of Sound Financial Group, and I'm joined, as always, by the illustrious Cory Shepard. Cory, are you as excited today as I am?
I am indeed. I'm excited to be back from a couple weeks away from the show, out of range of Wi-Fi. In fact, the whole days where I didn't even turn my cell phone on.
Nice.
It was amazing. Oh, I am the president of Sound Financial Group, by the way. If we're using titles this morning, I guess we are.
Well, there could be a new listener who's like, who are these people and why would I listen to them?
Right. Well, and we're so excited about being back and so excited about the topic, in fact, that we don't have a This Week in Planning article just because we have way too much to talk about. And Paul, I know you were really excited about this one today, so I will let you tell everyone what we're going to be addressing.
It's
today.
Roth IRA at any income. You see, one of the big things that happens when we meet someone new, it is amazing how often a new potential client will be going through our application process, etc., and they make $300,000, $400,000, $500,000 a year, even $250,000 a year, and they have no idea that they could be doing a Roth IRA. Everybody's told them you can't do a Roth IRA. They Google Roth IRA income limits, and it's also not a part of the regular communication out in the marketplace about how to do what we're going to talk about today called a backdoor Roth IRA. And stay till the end of the episode because oftentimes people are going to wonder, well, why in the world don't I hear about this? Guys, this seems so amazing. Well, the reason that you don't hear about it is because there's some real interests against everybody doing a Roth IRA, and it's not just the IRS.
So I think a good place to start would be just getting clear for everyone on what the contribution and deduction limits actually mean. Because first thing people tell us is, I make too much money to use a Roth IRA. And that's only partly true.
Indeed. So, Jordan, if you can cut to my screen here, we're just going to walk you through a little bit of the income limits of IRAs and Roth IRAs and why people get tripped up thinking that they can't do it. So to start off with, we just have a regular traditional IRA. This is an IRA you set up in your name. It's the IRA that's existed for decades. And you have no income limits. You can make as much money as you want and put money into an IRA. Mm-hmm. The income limits are based upon two things. One is, do you have a 401k? Because the income limits are not about contribution in an IRA. That's a big misnomer. It's about the deduction of the contributions to an IRA. So that traditional IRA is non-deductible if either spouse has an employer-sponsored retirement plan and the household makes over $74,000 if you're single or $123,000 if you're married. Now, Cory, will you just talk about the phase-outs for a second?
I mean, so starting at $103,000 for a married couple, you can't deduct all of your contributions to the IRA, but you can deduct some. And then by the time you hit that 123, you can't deduct any of it. Now, I get it. I know why, because the person, if it was just 123 and the person who made, 124 was cranky because like, $1,000 and I could have deducted, now I can't. So they set up this phase out range, but it's, it's only 20,000 and it's a deduction on a $6,000 contribution. So like the total net impact one way or the other, it's not like it's the hugest thing in the world. It creates all this needless complexity of, I got to keep track of this phase out range. I think it's one of the reasons why, the IRS is, considered a little bit inefficient. Like we have all this cost of administering the tax code and why people push for simplification. This is one of those things.
Exactly. And the one big thing to remember is that there is this phase out that occurs if neither spouse has a 401k. If one spouse has a 401k, you're subject to these phase outs on your deductibility of the IRA. Now,
the other side of it is that if neither of the spouse has a retirement plan at work, then you don't need to worry about the income levels for the purposes of deduction.
Exactly right.
Yeah.
That employer-sponsored retirement plan is key, not just 401k. There's several types of employer-sponsored retirement plans. All of them, if either spouse has one, will knock you out of the deductibility at any income. And you'll be subject to these phase-outs. That is traditional IRA. Now, if you are subject to the phase-outs, let's say you make $300,000 a year, have a 401k, something we see a lot for some reason, it tends to be around people who work in technology and highly analytical spaces. I would contest that it's because they understand the power of the math of compounding without taxation each year. So we notice a bunch of people will make after-tax IRA contributions when they make over a certain amount of income. And how that works is you have a basis, that's the amount you don't have to pay taxes on again. You make your contribution every single year, and then when you take your distributions, you pay your tax on the growth. Pretty simple. Here's the trouble, and we're going to talk about this again in a few minutes. It's your responsibility as the taxpayer to track that basis. So if you make a $5,000 a year contribution, to make my math easy here, I'm doing this off the top of my head, for 20 years, you have made a $100,000 contribution. If it's worth $500,000, then you have $400,000 of gain and $100,000 of basis, so that when you take distributions, you don't have to pay tax on the $100,000. And there's something called a pro rata tax rule we'll talk about as we wrap up this episode. But here's the key. It's your responsibility as the taxpayer to track that basis. So if you're making contributions at age 45 and maybe you don't take your first IRA distribution until 70, you've had to keep those records for 25 plus years. I have a hard time keeping hold of a pair of running shoes for a year and a half. I don't think I'm going to be able to track tax records for 25 years with the level of efficacy I would want to take those contributions back out tax-free. So let's transition to Roth IRA. Roth IRA has a phase out similar to traditional IRAs in how it phases, except the limits are a little bit higher. But now, once you're over the phase out,
why wouldn't they make them the same stinking numbers? Why?
They just need to make them higher because, feelings. I don't know why. So the Roth IRA phases out from 122 to 137 if you're single, and the phase out is 193 to 203 if you're married. Now, so for the most part, the clients that reach out to us and apply to become clients, we think most of our listeners just out of hand don't qualify to put money into a Roth IRA. And here's the trouble. Even if you're close, one of the problems that can happen is you make your Roth IRA contribution earlier in the year, and then your business is unexpectedly more profitable. You're having a breakout year. Or if you're an employee and you get a bonus. Because it's all sources of income, your regular wages plus your K-1 distributions from your business. But here is the part that gets fun, which is the ability to convert Roth IRA to Roth from taxable to non-taxable. We just have to pay the taxes one time. Now, you could do this all or in part. You could say, I have $100,000 in IRA. I'm going to convert it all this year. Cory, what happens to them tax-wise if they just convert all of an IRA to Roth in a single year?
That $100,000 in your IRA filters right into the tax bracket that your last dollar that you earned in your paycheck went, and potentially bubbles over into the next one. So you do have to be careful and be aware of where you are on those tax bracket levels. And no, it's not the end of the world if you bubbled over to the next one, but you do want to do the math to make sure that it's still a valuable transaction for you by paying the extra tax at that higher level.
Exactly right. That is key in the realization in the difference between your marginal tax rate and your effective. You might get your tax returns back from your CPA and it says that you paid on average 23%, but that includes your lowest brackets averaged with your highest brackets.
Right.
When you do an IRA to Roth conversion, it's going to be at that last highest bracket, which might be 30-some% for you, including if you're in like California, New York, New Jersey, or many, many other states with a regular state income tax also, you're going to have that taxed as well on the conversion. We don't get to escape it unless you move out of the state. So
now, Paul, can I just I'm the ranty one today. If folks are a little confused, this is where the confusion comes from, because they say, I knew that there was this income limit for me putting money into a Roth, but I can just change any of my money into Roth at any time still? Wait, I thought, yes, it's a situation that I think only politicians could create that is a little wackadoo. And it'll get even more wackadoo when we talk about backdoor Roth in a moment.
Well, and I don't know if you could do this really quick, Cory, and we can come back to it, but would you, just because I'd love to get the actual number, I know it's out there on the web, could you just look up while we convert to our next section here to tell me how much Mitt Romney and Mark Zuckerberg have in the Roth IRAs? Because there was some kind of disclosure they had to make to the SEC that disclosed this, and it's amazing. And why did they have this? Because they did one of these IRA to Roth conversions some time ago with some of the privately held securities that they had and the regular publicly traded holdings.
It's estimated that Mr. Romney has between 20.7 million and 101.6 million in an IRA account. And that's pre-tax.
Uh-huh.
Yep.
But there's another one out there for his Roth, I thought, and Zuckerberg's Roth.
And their Roth. Let me take a check.
So because what I think you all will see is that there is huge amounts of capital to be made outside of the regular IRS income tax system with the use of a Roth IRA. It's easy to miss because many people don't want to deal with the temporary pain, if you will, of paying tax today. And we do, much like you've heard us talk about, what's the guy from How I Met Your Mother?
Ted.
It's a future Ted problem, not a today Ted problem. Today, Ted gets the tax deduction. Later, Ted's going to have to pay tax on all those distributions. Because for our clients, for most of you listening to this podcast, for many, many entrepreneurs, you're not as likely to retire in a lower tax rate as the person that's a high income earning executive. Because you'll have the sale of your business. You'll no longer have all the deductions you run through your business today. You won't have the current Roth IRA or your 401k, IRA, deductible contributions happening anymore. And there you'll be taking distributions all at regular income tax rates. And that's if the IRS doesn't increase taxes due to all the spending that's occurred. Anything on either of those guys?
I haven't found Zuckerberg. I have found an article about Dustin Moskovitz, who is another. Oh no, Max Levchin, who started Yelp. He's got how much? 95 million in a Roth IRA.
Yep. That's perfect. No required minimum distributions, totally tax-free on distribution. And while it's subject to whatever death tax may occur, there's no income tax when it passes to heirs. It is an exceptional tool that is highly underused, but that even by Cory's example, some of the wealthiest people out there use. And now we'll have to do more searching and Googling. We'll put in the show notes if we find those articles to Mitt Romney and Zuckerberg's Roth IRAs. So let's look at what happens to be able to pull off the backdoor Roth IRA. You see, with a regular IRA conversion, it's pretty simple. We've just talked about it. All you have to do is take your traditional IRA, put it in a conversion. It stacks on top of your regular income taxes. Done deal. Now it's tax-free in the Roth IRA going forward forever. No required minimum distributions at age 70 and a half, which on a traditional IRA has up to a 50% tax on what you didn't take that you were supposed to take. And tax-free to heirs outside the estate tax system. We talked about all that. Just don't want to miss any of it.
Put an exclamation point for folks that when you're doing that conversion, you're going to want to have the cash in some other pot of money to pay the taxes.
Yes. Say more about that.
Because, so the IRS is very benevolent and allows you to create this conversion opportunity. But if you're under 59 and a half, they won't even let you take the money out of the IRA to pay them without charging you the additional 10% early withdrawal penalty. So if you're converting let's just make numbers easy, $100,000 IRA all in one fell swoop, and you're at 30% tax rate, then you need 30 grand in a savings account, in some other investment account that you can cash out for your tax bill come the next April, because it can't net out of that account unless you want to pay that 10% penalty.
I was going to say, then you take out the $30,000 from your IRA, then you better have $3,000 in savings to pay the extra penalty. Right. Which is typically the breaking point where we won't recommend people do that. But now let's talk about the backdoor Roth IRA and how it can be executed. You see, for many clients, you have a bunch of money inside your company retirement plan. Most of our clients are business owners. They control their retirement plans, so they can put a lot of their 401k based money there. We also have some of these clients, you could be one listening, that has a solopreneur type business, meaning we have clients that make over 7 figures a year. They have like one staff, no staff, or like a contracted virtual assistant and super low overhead. Or maybe you have a unique business, just you and your spouse in a consulting role. You may be able to ensconce your money into a solo 401k. If you have anything that has your money outside of IRAs so that you don't have any pre-tax IRAs, that's what this is going to apply to. I just want to be super clear. To do what I'm about to say, you need to have at least one spouse that has no deductible IRAs, or you've already gone through the procedure we just discussed to be able to convert the pre-tax IRA to Roth, so there's nothing left in pre-tax IRAs. Now, this is not per household like the 401k rule is around contributions. This is on a per spouse basis. So all you need is one spouse with no IRAs, and you can do what I'm about to say. So you have an unlimited opportunity to contribute to an IRA. But what we can do is choose if we want it to be deductible or non-deductible. In this case, even if we qualify to deduct part of it, we're going to choose to make it non-deductible. That's $6,000 per spouse per year if you're under the age of 50, $7,000 per spouse per year in 2019 if you're over the age of 50. Now, there's no income limit to contribute to that IRA. We're going to leave it non-deductible. Now, think about this for a moment. If you're listening, just picture it in your head. You have $6,000 you just put in to an IRA. It's non-deductible, which means we could, if we took it out in a qualified distribution, either converting it to Roth, or if we were over age 59 and a half and just decided to take it out, there's no taxes on it because we put it in after tax. That's part of the basis. We're just not waiting to let it grow to earn any taxable earnings. We put it directly into the IRA, immediately convert it to Roth. And we could do that every single year.
No matter our income level.
No matter our income level. And I got to tell you that, like, even as I re-say it this way, where I know I'm talking to many of you who've never heard this before, that it can sound really strange. Like, wait a second, you mean all I have to do is put my money into an IRA first and then immediately convert it to Roth, and I have a Roth IRA just like as if I had contributed to Roth? Yes, that is exactly what we mean. That is exactly how it works. There's no major mystery to it. All they're going to do is that the rule is on December 31st of the year you did this backdoor Roth IRA, they look to see is, do you have any other IRAs on the books? Because if you do have any other IRAs on the books, it's going to introduce something called the pro rata tax rule that we would ideally like to avoid for most of you. But the key is we just gave you the keys to the kingdom to be able to contribute for, say, 2 spouses, both of whom either have their money in 401ks or solo 401ks or some employer-based plan. They could be contributing as much as either 12 or, if both spouses are over the age of 50, $14,000 every year into a tax-exempt environment where they're not going to be subject to required minimum distributions and where they can withdraw the money tax-free. Now, something we didn't talk about very often, but does come up periodically, is people talk about asset location. We talk about that often, short-term, mid-term, or long-term money. And then there's asset allocation. That's one everybody talks about. Like, oh, how's your asset money allocated? In fact, that's what most advisors only talk about. So we want asset location, asset allocation, and asset taxation. Because then if taxes get out of whack in our old age, we have the ability to use this as a reserve to distribute money from in a way that is highly predictable and tax-free to manage our taxes more effectively upon distribution.
If I could re-rant one more time before we go to commercial, it's like people might be asking, well, why is there even an income limit in the first place if I can still get the money in? It's just creating more work and not really creating any more benefit. The pro rata rule might be one of the reasons why they did it this way, to force some of the more wealthy folk to churn through some of that money. We'll talk about it a little bit later, but it's a question that's somewhat unanswerable. I haven't seen an answer yet. Like, why do we complexify everybody's life? I just made up a word. George Bush hasn't been around for a while, so I had to,
I like that.
Yeah. So with that, I think it's a good time to go to commercial from Sound Financial Group and take a moment to hear a little bit more about how you can engage deeper with us at SFG and at Your Business, Your Wealth. And we'll be back with some of these pitfalls of a backdoor Roth in just a moment.
Hey everybody, I'm interrupting our show for a really important reason. We have a brand new white paper we're hoping you'll get value out of. Some of you actually might not even need the white paper. You might be ready to talk with Cory or I or our other team members about our philosophy. We'd be honored to do that with you, and it's in your control as to whether or not after that you would want to apply to become a client. We just want to impart more knowledge to you and make you better equipped to deal with the financial institutions and every offer that comes at you. But in the meanwhile, we also have this white paper that we want to give you, get in your hands to help be able to shift the way that you think about money. This white paper is going to show you 3 of the biggest mistakes we see people make and 6 ways to fix those mistakes to get you and your family on the most efficient track toward financial independence possible. You can get that by emailing us at info@sfgwa.com. That's info@sfgwa.com. And we'll look forward to hearing from you soon. We'll get it right out to you. We hope you read it. We hope it opens up your mind and puts you in a position to better be able to design and build a good life. Now back to our show. Welcome back to Your Business, Your Wealth. We are going to jump right into what are the pitfalls of the backdoor Roth IRA. They are aplenty and they can hurt. Jordan, we won't need to go to my screen right away, but we will in just a moment. So here's the first piece, is the problem comes up if you try to do a backdoor Roth IRA, and this is per spouse, remember, not per household. Per spouse, if you have an IRA, simple IRA, those both qualify. Simple IRAs don't count as an employer-sponsored plan the same way 401ks, defined benefits, money purchase plans, all that stuff would qualify as, okay? So it's simple IRA or IRA. If it's got IRA in it, it's going to count. Now, if those contributions were made pre-tax, you are going to have to pay some portion of the taxation on the entire account on a pro rata basis. So I'm going to do my best to explain this actually using a graphic from a blog of a gentleman named Michael Kitces, who actually does a majority of his writing and podcasts are to advisors, not to individuals. So he's not always the easiest to understand for a regular consumer, but he does a really great job. And thank you, Michael Kitces, for doing such a wonderful job of graphics every time you're posting something, so it really makes sense to people. So here is where, as an example, somebody tried to do a backdoor Roth IRA and what could go wrong. He's just illustrating it here. We have a $67,000 IRA. And that's all been funded pre-tax, either in contributions to an IRA or they contributed to an employer-based plan and converted it over. Then they made a $5,000 after-tax, non-deductible IRA contribution. That means that of all of their money that they have, 6.94% is after tax. So now we make a distribution. Now, a distribution could be made like you're over age 15 and a half and you're taking a distribution in your old age. That could be a distribution. But it's also counted as a distribution when you move an IRA to a Roth. So if this same person with $67,000 pre-tax and $5,000 after tax, giving them an IRA worth a total of $72,000, we're to say, I'm going to try to do a backdoor Roth with this $5,000. What's going to happen is that only $347 of the $5,000 conversion to a Roth IRA is going to be tax-free, because the inverse of the 6.94%, effectively 93.06%, 93.06%, that's what I get for doing math in my head live on the show, is going to be taxable. So the backdoor Roth IRA, being able to do this without any income tax consequences, meaning you made the IRA contribution after tax, made the Roth conversion immediately after, does not work if we have other IRAs. It invokes this pro rata tax rule. And here's our bigger problem. Remember earlier I mentioned to you that you could be responsible or are responsible for keeping track of your basis when you made non-deductible IRA contributions. Now, Cory and I have watched over the years, finding people that have accumulated, say, over 5 or 6 or 10 years, a bunch of pre-tax post-tax contributions mixed with pre-tax contributions to an IRA. Some were rolled over from 401k, some were contributed. Here's the major problem with that, is that now you have to track that basis. And in this case, you created basis, but you have to also do the math of, oh, well, there was $5,000 that was after tax. We used $347 of it for the pro rata tax rule. That leaves us with $4,653 of basis that I can use later when I take the distribution. You can get a sense of how painful this could be.
I think there's only one person that I've met who actually had all the records. That's our very own Jeff Miller. And it still took him just ages to go put it all together to
my goodness,
usable. So best case scenario is you're going to spend a bunch of Saturdays coming up with everything. Yeah.
Best case scenario. And that was contributions he'd done over the prior 10 years. If, and I think Jeff has said as much publicly, if he had not met us, odds are he wouldn't have known that. His records would have been too old and there would have been no way to track it down. By the way, if you're making distributions when you're in your mid-70s, do you think that is how you want to spend your weekends? Is trying to figure out how many non-deductible contributions you made to an IRA 30 years ago? Oh. So with that, this is the problem with the pro rata tax rule. We try to avoid it at nearly any cost, and it's okay to not be able to do this. It's just that if you do qualify to do the backdoor Roth IRA, you should do it every chance that you get because the compounding capacity is amazing. I'm going to just pull up a very quick time value money calculator to give you guys a sense of it. I don't need to run two of them. I'm only going to run one. But I want to give you a sense of how big of a deal this is. If somebody has the ability to do $6,000 a year to an IRA for 30 years and they get an 8% rate of return over that period of time, that would be a total of $734,000. And if we could do it for both spouses, again, the IRA contributions increase a little bit every year. Although, for the sake of this conversation, we're just saying $6,000 a year per spouse for 30 years running. That's almost $1.5 million. It could be in an IRA. But if it's in a traditional IRA, how much that belongs to you? 65%? Because that tax liability moves with you through time. Unlike a mortgage that gets slowly paid off over time, it's much more like a shadow that you cannot outrun that tax liability. And the only difference is how you behaved on the front end and whether or not you could do a backdoor Roth IRA, because then it's the exact same number of 1.468 million, except it's tax-free. That's the power of doing this. It's super small on the front end. It's super big on the back end. All right. I think we're done with my computer screen, Jordan.
And this, this basis tracking forever issue becomes not an issue if you have no IRA balances or if you've converted all of your IRA balances to Roth IRA, which you may want to do anyway if you have a large 401k deferred tax balance anyway. That's where most people started saving and investing. Then you may want to balance out your tax channels anyway and be in a strategy of IRA to Roth contributions. So you can get yourself out of it. Once they're converted, then you don't need to track that basis anymore.
We work to do a tax review with our clients every year around November, at least November, maybe earlier, so that we have some lead time before the calendar year ends. And here's why. Let's say in your business, you're having a rough year this year. You did some major reinvestment. You hired, that new key executive that you had to pay $250,000 a year so that you could spend more time with your family. Anything that created a significant draw down on your income. Perhaps you set up a captive insurance company or a unique defined benefit plan that has your income a lot lower than most other years. To Cory's point, that might be a great year to trigger an IRA to Roth conversion because you have this extra latitude. We even do it sometimes for our retirees. In a year where maybe they make a large charitable contribution, it can make sense to convert a chunk of IRA to Roth that year. And one little technique that Cory and I run into periodically.
So clever. So sneaky.
If you're a business owner, and this is key, you should make sure that you are controlling the investment structure in the 401k you're going to do this with. Too often, we won't have our executives do this because there isn't enough control over the plan's 401k to control the way their money's invested properly. But if you control the 401k and we can make sure you have solid investment options that are academically allocated, globally diversified, and low cost, then you can hide your IRAs in your own 401k. Or if you're one of our solopreneurs, you could do that inside of a solo K, leaving only the IRAs that you just created that have basis because it was non-deductible. And then you can do the backdoor Roth IRA. It's a little bit of a step process. I would not what is it? Like stunts do not perform without adult supervision or without professional supervision. This was done on a stunt course by professional drivers. Do not do that one like solo by Googling. That can be highly complex. In fact, several of these things maybe should not be operations not to be executed by Google.
So, Paul, we promised them at the beginning that we get to talk a little bit about the answer to why in the world have I not heard about this before?
I know.
Maybe what a lot of people are thinking.
And by the way, it hurts mine and Cory's heart every time we know that somebody didn't know about this. And we like some of the biggest, like most prestigious wealth management firms out there have had clients that they have lost to Sound Financial Group. Or I should say, we have had clients that were clients of them who have gained through their new relationship with Sound Financial Group. For this reason is just simply being able to say, those people, and I don't want to name any company names, but, they would rhyme with things like, Northern Trust and, like Daryl Lynch, Private Client Group, things like that.
Yeah, right.
So when they're at those firms are concentrating so much on the asset allocation and asset performance. They're not looking at some of the broader view. And when I sit down with somebody and say, why did they, for the last 10 years, not bring up the backdoor Roth IRA? You would have qualified this entire time. And they go, what do you mean? And sometimes the difference by the time we meet them could have been hundreds of thousands of dollars they could have had in Roth IRA by the time they get to us. So why is it, Cory, that they don't tell all their clients all the time about this opportunity?
So a big part is that it's a major disincentive for the advisor. Meaning a client might think, well, I'm putting the non-deductible contribution in and then all of it's going over. So the advisor's managing the same amount, except you've got to pay that taxes from somewhere else. And on that $100,000 account, that 30 grand in taxes that was in savings was going to get contributed to their investment account. Maybe it was in a brokerage account that the advisor is managing. That goes to the IRS, doesn't stay with the firm. So there's a major disincentive for big box financial retailers and the e-tailer firms to teach advisors how to do this.
Robo-advisors don't teach it. Right. The no-load companies don't teach it. Like, look at all this is not so complex. Like, yes, a banner ad on Facebook could communicate this. Like those little, why don't they? Well, in part because of what Cory just said.
It's also double the paperwork for a $6,000 contribution, and
for every client.
Every month, yeah.
Every client. So, and the what Cory just said, like on 100,000. So if you have $1 million IRA, it's less likely your advisor is going to want to do the math with you, because the advisor and the brokerage house they work for will make 30% less post conversion, because you'll move the $1 million from IRA to Roth. But then on the other accounts you have with them, they're not in retirement accounts. You'll have to take $350,000 out. That's a lot less money for the advisor to manage, and almost guarantees that your money will be less sticky. So stickiness is something that's taught by these large financial institutions, that your money is less likely to move from either one brokerage house to another or to actually be withdrawn. And IRAs are considered one of the stickiest assets for these asset management firms because of two reasons. One, if it's a retirement account, whatever statistic why, you're less likely to move it from one institution to another. But second is that when you take the money out, the institution doesn't need to punish you, because, Cory, who's going to punish the client for taking the money out?
The IRS?
Yep. And they have guns. So
they do. That's true.
So when they say, hey, we're going to take this money, you next year don't want to take as much out of your IRA. You'll consider taking it out of elsewhere. And The brokerage house is getting to manage both the IRS's money and your money. We've talked about this before, but I cannot stress it enough. If you're in a 35% tax rate and you have $1 million invested, only $650,000 is yours. $350,000 belongs to the IRS. And here you are doing things like listening to this show so you can do better with your money, but you've got a partner 35% in their retirement account, and that partner is benefiting from all the work you do to be better with your money. That doesn't mean you should never do a retirement account. It's just us looking in and telling the truth about what's actually there, what's available, and how much is yours.
And
so, go.
Gosh, required minimum distributions we've talked about in the past. I know you've heard from us, but the IRS literally knows how objectionable it is to people to take money out of these accounts later in retirement. So they force us to, through required minimum distributions, starting at 70.5. So here's the question. If the IRS knows you're not going to wanna, and they're going to make you, then when do you think you'd rather do it? At their timing down the road, or maybe as soon as possible? That's the question that we float.
And if you don't take distribution, it's your taxes plus an extra 50% of what you didn't take.
Yeah.
It's one of the most draconian punishments the IRS has for us. It's bad. Now, here's why the institution also love it. We talked about stickiness of assets, but financial institutions, attorneys, all kinds of folks will teach things like stretch IRA provisions. So if you have a really, really big IRA, well, you don't want your children to pay taxes on this all in one shot. And then the quiet part that they don't say out loud is, and we don't want to lose all the assets that would be managed because your heirs have to take out, 35% of it to pay taxes all in 1 year. That part they don't say. But they will say, well, stretch this out, slowly pay the taxes over time. Look how much wealth can be created for the next generation, but we're still not escaping that embedded tax. Think of it this way. The financial industry has taught people to make enormous contributions to these pre-tax accounts, to do so in a way that may even drive them into a higher tax rate in their old age, creating that shadow that you can't outrun. And I think Cory put it best pre-call. Will you give the quote? I think you deserve to say this one. It's so good.
It just, the way it occurred to me, it was if the New York Times published an article tomorrow that all these doctors had been creating a problem that they were then making money off of by selling the pill to treat the symptom, but never actually doing away with the problem that they had created. The scandal would be unthinkable in that case. But this is exactly what's happening when year after year firms aren't talking about the ability to do this, aren't offering people the chance to do backdoor, do solo K if they could. Like, this is huge, yet it doesn't get talked about, which is why we were so jazzed about this episode at the beginning.
And I'm glad you guys could hang with us through that. We know we went a bit analytical. If you haven't had a chance, watch for this also on YouTube. Be sure to like it, and you could share it. If you're like, do I qualify for this? And you want to, kind of nudge your CPA or nudge your current advisor, send them this episode or reach out to us directly. We've given you through the commercial and at the end of the episode how to do that, but always know you're welcome to reach out to info@sfgwa.com. I cannot tell you how much we appreciate your reviews on iTunes. It really helps not just us, but it helps all the people that are inevitably going to find one of these episodes because you took the time to care enough to write a review, give us an honest rating, and put other people in a position where they might get a chance to hear a show like this one. And your review, your sharing of this episode might mean the difference, no kidding, to the tune of hundreds of thousands of dollars of additional taxes in retirement, all because you took the time to pay it forward with a short review or take this episode, hit that little 3 dots next to it, and text it to a friend saying you've got to hear this. Let's talk a little bit about our giveaway this week. Cory, what do people get if they send us a screenshot of said review?
You have a choice of sound financial advice from Paul Adams, Cape Not Required from Cory Shepard, or Clockwork from Michael Michalowicz. And again, an honest review does not have to be of any particular flavor. We just would appreciate you giving your feedback and send us a screenshot to info@sfgwa.com and let us know which of those books you'd like. Send us your address and we'll get that out to you in the mail. And we've got a great review today. It was made recently, just a couple weeks ago, by Joel. And Joel says, Cory and Paul do a tremendous job breaking down complicated financial concepts and offering useful tips.
I agree with
I
him.
just listened. I agree.
He didn't say anything about the good looks, but maybe he's only listening on the podcast.
Yep. I just listened to the episode 149 about 529 plans. My wife and I have a 10-month-old daughter, and we're preparing to set up a 529 plan, but we've decided against it based on information Cory and Paul laid out. That single episode likely saved our household a lot of financial heartache. Joel, thank you so much for letting everybody know what you got from the podcast.
And I can't help it. I of course I read this before, Cory, but I'm like a little choked up because one of our listeners may have just forwarded this episode. He might have been somebody who requested one of our free white papers from before in a prior podcast, got it in his email, ran across it randomly on Facebook. But they were able to make a very different choice in life that gives them more agency and autonomy with their money beyond what the financial institutions look to deliver to people, which is the delivery of a product to answer something that people want. And they do it for all sorts of stuff. And most of the products are not designed to be owned. They're designed to be sold. And things like 529 plans, things like, I think another episode we're going to have to go through the list of the tools that are really good for advisors to sell, like meaning the narrative sounds good, but they're really terrible to own for several decades in a row, and let our listeners have some taste of that. So Joel, both thank you for taking the time for your future to be able to be a listener of the podcast. And thank you to all of you who make that review, who text this episode to one friend, because it has the ability to make a profound difference for them and ultimately make a profound difference to you. The better people are thinking about money to your right and left as you go through life with them, the better you're likely to do. And Cory and I, from the bottom of our hearts, hope that this podcast, much like that podcast was to Joel on the 529 plans, has been a contribution to you being able to design and build a good life. I hope you enjoyed today's video. Thanks for watching. Be sure to subscribe to our channel, ring that bell, and by the way, make sure to share this video. I don't know if you know this, but my cyborg body runs 100% on YouTube views and likes. Please don't let my batteries die.